Well, Dibanisa Fund Managers, a subsidiary of Omixa, applies intellectual capital developed by research affiliates to create exchange-traded funds. One of these ETFs is the FTSE RAFI World 3000 Index that includes global stocks weighted according to fundamental metrics like cash flows, sales and dividends. Here to discuss where the portfolio is finding value is Craig Chambers from Dibanisa. Thanks very much for your time. Last night we were chatting to Jeff Blanc, the CEO of Cannon Asset Managers, and I see you've brought an analogy here in terms of Apple being overpriced. And just to put it into perspective, Jeff made the point that you could either buy Apple or the whole of Southern Europe. And he made the statement he would rather buy the whole of Southern Europe. I don't know if you're in the same camp.
Yeah, absolutely. I think the way RAFI does things is, as you mentioned, it weights things based on cash and dividends, etc. And obviously it's not seeing a lot of value in Apple. In fact, it has a 10 times underweight position in Apple. It has a 0.3% weight in its index as opposed to the normal index at over 2%. And I think it's just on the back of Apple having run so hard. In fact, the statistic is that it's at 5.2 trillion. It has a weighting which would be larger than the whole GDP of Switzerland. So really what you see with RAFI is it's a contrarian play. It's a deep value index that seeks out high dividend counters that will be defensive for the man on the street, and the reason why we decided to launch this particular index.
So Craig, just to get this right for our viewers, this particular technology or intellectual property, if you could call it that, it scans which stocks in which part of the world does it look at to include in the index, and then just talk about how those metrics actually work. Does it rank them according to each metric and take the best score, or how does it do? Does it use a combined score? I
think the power of RAFI is that it's a pretty simplistic methodology. So in terms of our history with the product, it goes all the way back 5 years to 2007 when we launched a South African unit trust for the man on the street. It's a very low total expense ratio, and it's done very well. It's in the top quartile over 4 years. So for us, it was a natural progression to take the technology, having seen how well it works, and apply it to the global context. So what happens is that you have a base benchmark, which is your FTSE All World Index, 3,000 stocks. And then what RAFI does is it looks at each and every stock. It completely ignores its share price and by definition its market cap, and it looks at its fundamentals, its cash, its dividends, its book value and its sales. It weights those at 25% each, so quarter each. It looks at its 5-year history in each of those matrices, and it determines a weighting for that component relative to the other 3,000 counters, and hence the weighting that it gets. And that's why something like Apple has a down weight, because it gets penalized for not having invested any or issuing dividends.
There are a couple of other themes unfolding at the moment, and the one being that the defensive stocks, like your healthcare counters globally and your consumer stocks globally, not just in South Africa, are looking overpriced.
Exactly. Same thing. Once again, RAFI in a very systematic, cold and calculated way, determining from the bottom up which stocks to pick. It's got a big underweight in US healthcare, as well as counters like Coca-Cola and Nestle, big multinationals that have run very hard, very similar to what we're seeing in the local context with the likes of the Imperials and the Bidvests.
Obviously, the converse of that is, where is the value that RAFI is seeking, specifically in the local and global market?
Well, once again, because it's a very long-term orientated product, what it's done is it's looked at the value in banks, for example. So its largest weight is Bank of America. It has big weights in the Spanish regional bank, Banco Santander, which has got fantastic dividend growth. I show a chart of how it's superlative relative to the market. And a lot of those banks still have superb prospects. And as a result, RAFI seeing value in that particular sector, as well as the energy and gas sectors, high dividend yields, well over 5%. Again, it has overweight positions in those particular counters.
It's no surprise, Craig, that the area of attraction, the geographical area of attraction when you look at it is obviously coming from Europe and the United Kingdom. So just in terms of those countries, what is their makeup in the index? And what other countries are included? I mean, obviously, I presume that the United States would be included, but what about the likes of China and the Hong Kong markets? Are those included in the index as well?
Yeah, I mean, there's 48 countries included in the index across those 3,000 stocks. The US making up the bulk of the normal index at 45%. RAFI is an underweight to the US at 5%, so coming in at 40% on the back of the underweight to IT and healthcare. So the overweight positions in terms of France and Germany, they tend to be between 5 and 10% of the particular index. But clearly that's where it's seeing the value. It's seeing the value in stocks like Deutsche Telekom with a dividend yield of well over 5%. E.ON, which is an energy and gas producer. Vodafone, as you know from our local context, is a company that would spew plenty of cash. And as a result, it has overweights in the UK on the back of Vodafone.
What does Rafi say about Anglo-American?
There's underweights, believe it or not. It has I can't tell you specifically on Anglo, but in terms of resources, it has a 2% underweight position. Global resources within the index is at 7%, and it has a resource weighting of only 5%. So chances are it's probably got a decent weight in Anglo. If I can comment in terms of our local Rafi, it has an overweight position in Anglos and Billiton as a result of the beautiful cash that's generating and the low PEs.
So basically what it's saying, if you compare the local and the offshore and this particular Rafi, is that the local companies like Anglo and Billiton are looking cheap relative to the rest of the market here, but on a global perspective they're not as cheap as some of the other companies in the world.
Yeah, could well be the case. In terms of what the makeup is of where it's underweight in terms of Rafi globally, it could be in some of the gold counters, for example. But chances are that in terms of Anglo and Billiton, it's probably consistently overweight those counters in both the global as well as the local context, just given the fundamentals.
Why go Rafi? Here's your sales pitch. Well, why should we go with Rafi?
Well, first of all, it comes in at a total expense ratio of well under 1% for the man on the street. You can invest 500 Rand and get a TER of 80 basis points. The average in the foreign general equity sector and the unit trust sector is 2.07%. So you're getting a huge discount. It's well diversified. It's a value-orientated index, and we know that value tends to outperform over the long term. It's underperforming in the last year because it just doesn't like the likes of the bubble that the IT sector is creating in the US. So it's a strong methodology, and for a person who just wants to get exposure from the Rand, oil hedging, for example, in terms of that overweight to gas, etc., it makes a lot of sense to invest in something like our Rafi All World, which we launched in September.
Craig, just to also one of the advantages, I guess, but there's another question coming after this one, is one of the beauties of buying into an index like this is that the South African investor can get exposure to a whole range of industries and companies that we just don't have in our local market. Can you just elaborate on what some of those industries are? And I know you've mentioned Apple, and there's a real big technology component to it, but what are some of the other sectors that the investors get when they buy this?
I think the key thing is they get a very diversified range across deep value stocks. So, it would be very unusual for a lady sitting in Pofadder to have exposure to Banca Santander.
I was going to say European banks stand out as an anomaly.
And obviously, what I quote is a guy called David Hero, who, according to Fortune and Morningstar, was rated as the International Fund Manager of the Decade in 2010, and he has an overweight to European banks. So, you could go in and get exposure to an international manager like that, which would cost you a huge amount of money, and that particular lady wouldn't have any idea of who to select. Or you can go into a tracker fund like ourselves, where it's a very simple methodology and it's been proven. In fact, there's $100 billion invested in research affiliates strategies across the globe now. So really a lot of credibility, been around for almost a decade. I think it's a no-brainer to put a stop order on and get that Rand hedge and that global diversification.
Is it not too diversified though, Craig? I mean, we're talking about a universe of 3,000 stocks in 46 countries with a market cap, combined market cap that must run into the trillions of US dollars.
Yeah.
Is it not too diversified? Is there such a thing?
I was going to say, is there such a thing as being too diversified in an uncertain environment?
Yeah, no, I agree. I think that, look, the statisticians will tell you that correlations have increased across the globe to a large extent anyway. But certainly just from a currency perspective, you've got all those countries in terms of diversification from hard currency, from the euro and the dollar, etc. So that certainly helps. If you're a more sophisticated investor and you go through fund to fund or whatever the case may be, you would want a guy that's got a proven long-term active track record of investing in 50 global counters plus our very diversified index. That's if you have the ability to actually pay for a financial advisor. We never say it should be just active and passive. If you can afford it, you should have a component of both, because sometimes that very focused portfolio will outperform, but having a component that's nicely diversified will help. But if you just have 500 Rand to put away, then in my view, this is the way to go.
What traction are you seeing from the retail investor? Is there aggressive uptake of the product?
We're certainly seeing it from what we call the fund-to-fund guys. So essentially the guys that will allocate across their funds, which will then go across into the retail environment. We launched the fund in September. We've already had 300 million in flows. The actual underlying fund in this particular product, this RAFI All World, which is actually listed in Dublin, we launched at the beginning of the year. It's got $360 million of uptake in that fund from South African investors already. From institutions mainly, and some from retail. So there's been great uptake. In fact, our international funds have grown by almost 16 billion in 2 years. The money that we've managed to attract from international investors looking for us to track their assets globally, or from South African pension and retail clients looking to invest a component into our international tracker. So it's been a runaway for success for us, and we think it will continue.
Craig, just in terms of this, it's quite interesting because obviously exchange-traded funds, many people understand that to be something that they buy on the securities exchange themselves. This is a passive active strategy, passive value strategy, I'm not too sure what the right word would be, that you actually access through a unit trust fund. So what are the differences for investors between accessing a RAFI strategy, either by buying it on this exchange directly or through a unit trust fund?
It's a great question, Warren, and I think it's very important to emphasize that often what gets quoted in the press is the total expense ratio of the exchange traded fund, because there are similar global indices or similar RAFI local ETFs out there which compare to our unit trust. But what they often do is they compare the total expense ratio of that ETF to the total expense ratio of our fund. So in this international context, it will be about 80 basis points. And an international ETF on our local exchange will probably be at about 110 basis points, 1.1%. But what they don't talk about is the fact that you don't just purchase an exchange traded fund, you need a platform. And within our total expense ratio is our old mutual Manco platform fee. Now, if you go to a normal retail environment in which you need a platform, it'll cost you about an additional 0.8%. So it's very important to add the platform fee onto the exchange traded funds total expense ratio before you do the comparative. And when we've looked at that, and guys like Bruce Cameron have studied it in detail, they've actually come to the conclusion, and this wasn't their view before, that going via the unit trust tracker is actually more cost effective. And he's written about that than going via the ETF once you add in the platform fee.
Okay, so it's very important then to if you're using a platform on the ETF side, they call them investment plans if I'm not mistaken.
Correct, yeah.
That you compare that cost along with the total expense ratio of the security against the TER for your unit trust, which includes the platform fee. Is that right?
Exactly, because it can be almost double the cost. Once you've added in the platform fee, our cost is potentially much lower.